1. Germany's €34.1 billion pension invests in China stocks, what it means for global markets. 2. Foreign asset managers investing in Chinese equity market, opportunities and trends. 1. Germany's €34.1 billion pension invests in China stocks, what it means for global markets. In a bold move that diverges from the norm, a German pension fund, managing a hefty €34.1 billion, has chosen a Chinese company's Hong Kong branch to oversee a portion of its investments in local stocks. This decision marks a significant shift, as global investors have traditionally approached the Chinese market with caution due to its complex economic and geopolitical landscape. The Cologne-based KZVK, responsible for the retirement funds of over 240,000 pensioners, allocated $50 million to Fullgoal Asset Management, HK, during the second quarter. This investment aims to tap into Chinese equities listed not only in Hong Kong but also on mainland exchanges and in the United States. This information, provided by insiders who prefer to remain anonymous, highlights a cautious yet strategic approach to diversifying investments. Despite recent economic stimulus measures in China that led to modest market gains, the past few years have seen significant volatility. This includes a sharp downturn driven by regulatory crackdowns, a slowing economy, and escalating geopolitical tensions, which have taken many long-term investors by surprise. Consequently, most allocations to China's public markets are now renewals rather than new investments, according to analysts. Cameron Systemans, a leading figure in multi-asset strategies for Asia at Mercer, noted, "We have not observed a significant trend of European and US asset owners allocating mandates to Greater China." He added that their current advice to clients is to avoid long-term strategic commitments to specific national markets. Interestingly, despite this new mandate, KZVK's overall exposure to China remains conservative. Oliver Lang, a member of the management board, revealed in a May interview with Investment and Pensions Europe that the fund is underweight in China compared to its economic size and market capitalization. Fullgoal Asset Management, headquartered in Shanghai, manages approximately $200 billion in assets and includes significant shareholders like Canada's Bank of Montreal. Its Hong Kong division handles about $30 billion Hong Kong dollars. But here's where it gets controversial. While KZVK is cautiously increasing its stake in China, there's a notable pivot in the investment world towards other Asian markets. According to a recent Morningstar report, the number of ex-China equity funds has exploded, with a record number of launches in the past 2 years, amassing an impressive $10.5 billion in new capital last year alone. Machu Kakino of Morningstar points out that the regulatory crackdowns, rising geopolitical tensions, and the economic uncertainties following the COVID-19 pandemic have rattled investors, fueling the growth of funds that exclude Chinese equities. This strategic investment by KZVK could be seen as a test of the waters or a sign of changing tides in global finance. What do you think? Does this indicate a new confidence in Chinese markets, or is it merely a cautious hedge amid broader uncertainties? Feel free to share your thoughts and engage in the discussion below. 2. Foreign asset managers investing in Chinese equity market, opportunities and trends. Imagine this, a global shift in investment strategies is underway, and at the heart of it all is China. Foreign asset managers are increasingly turning their attention to the Chinese equity market, drawn by its vast potential and resilience. This trend is not just a fleeting interest, it's a strategic move that could reshape global financial landscapes. But here's where it gets controversial. While some see this as a golden opportunity, others question the risks and uncertainties involved. Let's dive in and explore the nuances of this evolving financial landscape. A recent move by a German pension fund, KZVK, has caught the eye of financial analysts worldwide. KZVK has allocated a substantial $50 million to Fullgoal Asset Management, HK, to invest in Chinese equities listed in the Hong Kong Special Administrative Region, the Chinese mainland, and the US. This isn't an isolated decision. It's part of a broader trend where global asset managers are ramping up their investments in the Chinese equity market. The allure? The Chinese A-share markets demonstrated resilience and vast potential amidst a strategic global capital rebalancing, according to Chinese analysts. This trend isn't new. Earlier this year, the private equity arms of Singapore-based True Light Capital and global asset manager Ernest Partners Private Capital both completed their filings with the Asset Management Association of China. These moves signal a growing confidence in the Chinese market, despite the complexities and uncertainties that come with it. Analysts at Nomura Orient International Securities predicted in June that Chinese equities could outperform global peers in the second half of 2025. Their optimism is fueled by expectations of more supportive policies, improving domestic liquidity, and rising global interest in Asia-Pacific markets, all amidst a weakening US dollar. This prediction, while promising, raises questions about the sustainability of such growth and the potential risks involved. Yang Delon, chief economist at Shenzhen-based First Seafront Fund, highlighted the significant rebound in the money-making effect of the A-share market compared to the same period last year. Tech shares, in particular, have shown strong performance, with sectors ranging from humanoid robots and chips to innovative drugs and new consumption all displaying active trends. Yang also noted that China's stabilizing growth policy is set to further intensify, boding well for both the A-share market and the Hong Kong stock market. Dong Xiaopeng, a senior research fellow at the Chongyang Institute for Financial Studies at Renmin University of China, echoed these sentiments. He noted that China's resilient economy and sound growth potential are injecting more optimism and growing interest in Chinese assets among foreign investors. The latest investment allocation by the German fund, Dong suggested, could be just the beginning of a larger trend. But here's the part most people miss: the strategic global capital rebalancing that has been quietly unfolding since the beginning of 2025. This shift is marked by outflows from US dollar-denominated assets to non-US dollar assets, driven by relatively low valuations in emerging markets and breakthroughs in artificial intelligence. China's transformation from the world's factory to a global technology innovator is set to further unleash the growth potential of Chinese technology stocks, according to experts. The steady projection for the Chinese equity market is coupled with a need by global fund managers to diversify their portfolios amid a weakening US dollar. Liao Wanjing, a manager with Fidelity International, highlighted the decline of American exceptionalism and the growing demand for diversified investment, which have further promoted the integration of China into the global financial system. This integration increases the exposure of global investors to Chinese assets or yuan-denominated assets. China's A-share market has shown growth in the first half of the year, with the benchmark Shanghai Composite Index showing a cumulative increase of 2.76% to 3,444.43 points. The Shenzhen Component Index finished the period 0.48% higher, while the KINEXT Index, tracking China's Nasdaq-style Board of Growth Enterprises, rose 0.53%. These figures paint a picture of a market on the rise, but they also raise questions about the sustainability of this growth and the potential risks involved. So, what do you think? Is this a golden opportunity for global investors, or are there hidden risks that need to be addressed? Share your thoughts in the comments below, and let's spark a discussion on the future of global investment strategies.